Hello and welcome to our webinar, Things You Need to Know Before You Get a Mortgage. This webinar is part of BWG Wealth Management's Your Life series, a series dedicated to helping our clients learn more about the topics that impact their financial lives. I am Christina James, a certified financial planner and wealth advisor at BWG Wealth Management. Today, we are talking about mortgages. I have a special guest joining me, Patrick Maloney from Ameris Bank. Patrick is the regional area manager for the Mid-Atlantic and helps advise clients on financing residential homes. He has over 30+ years of experience in mortgage lending. As financial advisors and fiduciaries for our clients, we are often asked questions about our clients' real estate purchases and what options might be available for them. Without further ado, Patrick, I'd like to ask you a few questions that could help our clients evaluate the best options for them. But I guess before we get started, can you tell us a little bit about yourself and what you do?
Thanks, Christina. Yes, I've been in the mortgage business for 30+ years. I fell into it by accident. I ended up selling a phone system. I was in phone sales in the late 80s. I sold a phone system to a mortgage company and ended up in the business. Since that time, I've financed well over $1 billion worth of first trust residential mortgages in all types of scenarios, whether it be a VA loan, an FHA loan, or conventional loan, for clients that range anywhere from first-time buyers to people who were downsizing or even in retirement. So that just gives you a little bit of background about me.
Yeah, well, I'm sure in 30+ years, which, by the way, you do not look like you've been in the mortgage industry for 30+ years.
Thank you.
But I'm sure you've seen just about everything. And in particular, going through the credit crisis back in 2008, I used to work for a bank, and I remember that time very vividly. Tell us a little bit about the mortgage process and how much harder it is, or maybe it's easier than it was in 2008, how things have changed.
Yeah, so that's a very good question. The mortgage industry, when I first started, was what they considered a rules-based origination, which meant that we followed strict rules on how much of a mortgage payment you could have based on what your monthly income was. In the late 90s, both Fannie Mae and Freddie Mac designed a system that are origination systems that analyze people's credit and it analyzed people's incomes and so forth. And it became instead of a rules-based underwriting system, it was a risk-based underwriting system. So for instance, if you put 50% down on a house, we really didn't ask a whole lot of questions about income. We just realized, we thought that those mortgages would pay back because there was such a huge amount of equity in them. Well, obviously,
if we only, if they only knew.
So obviously that whole process and so forth didn't really turn out so well, and we ended up in the credit crisis in about 2008. And from that point, everything changed dramatically and really pulled back. So we went from not really looking at a whole lot of information to looking at every piece of documentation. Mm-hmm. Now, in the last couple of years, that obviously has changed as well. So some of the things that you would have run into back 5 or 6 years ago when it was very, very painful to get a mortgage now have loosened up a little bit.
Oh, really? Like, what would you say is something that's loosened up? I mean, are we just doing stated income again, or? Well,
there are talks of some of those programs coming back, but you most likely won't see anything like we did 10 years ago. However, what you'll see is, 5, 6 years ago, when you brought a bank statement in and there was small little deposits on it, we would scrutinize every single deposit, painfully scrutinize those deposits. Now, we look at those more as really just understand that's your day-to-day business, and it's not scrutinized to that extent anymore. And a lot of things have been automated in the last even 5 years.
Oh, that's a relief. Well, I know at VWG, we work with our clients to create a customized financial plan, and oftentimes that's including maybe a second home purchase or a first-time home purchase, a vacation home. How do you determine the structure of the mortgage? You know, I know I've worked with you a few times in helping create someone's financial plan to say, hey, is this a realistic scenario? But what process do you go through with your clients?
You know, that's a great question. So when we look at a customer's financial goals, you know, ultimately everyone's a little bit different. So you might have somebody that is trying to either purchase or refinance their primary residence. That's looked at differently than if it was a second home or an investment property. But depending on where it is, or if you're downsizing, or if you're in a move-up situation, all those things are taken into consideration when determining, you know, what the best mortgage program for them is. But every person, every situation is different. You know, it's kind of like they say, every snowflake is different. Every mortgage is different to some extent. None of them are really straightforward. So for instance, a self-employed person who might not show or is required to show as much income as we would like to see, there's some alternative types of financing programs for them. There's programs such as income-based or asset-based you know, loan programs that allow us to take the assets and show a dissipation number over a period of years to use that as an income stream to qualify for a mortgage and such.
Interesting. So I know at VWG, we have a lot of our clients that are delaying retirement plan distributions because they're not 70 and a half yet. So they're not required to take them out. So they don't want to force that distribution. But obviously they have the ability to take it. So is that an example of when you would use asset dissipation to help them qualify? As, right, they've got this large IRA, they're over 59 and a half, they're clearly entitled to the distribution, but they don't need it, so they're not taking it. They don't want to pay Uncle Sam.
Yeah, so in that particular instance, we would have to discount to some extent an IRA type of asset to be able to use that as an income stream. If you started a stream off of that IRA today, we could use 100% of that income as long as it's going to last based on that number for the next 3 years, for instance.
Oh, interesting.
So, yeah, so as long as that income is, you know, to give you an example, so if you were going to use $10,000 as the income stream off there, you would have to have at least $360,000 in that account for us to use that income to qualify you for that mortgage. But there are some alternatives, and there are some things that the mortgage industry has designed, understanding that our population has been aging and the financial, there's a lot of assets. However, they, you know, maybe their situation's a little bit different. So there's a lot of tools we have to be able to use for that.
Very good. What would you say to someone? I mean, mortgage rates are historically low. They've been at historical lows for a while. What would you say? And I know I see this scenario a lot in financial planning. Clients have enough cash to buy the home outright. Should they have a mortgage?
You know, that's a personal question for the most part. If you asked me that question 20 years ago, I would have most likely said, I would recommend you pay off your mortgage and not carry any debt. However, if you look at rates from 20 years ago to today, and the cost of money is extremely inexpensive, there might be a better vehicle for you to use. You know, obviously that would be a decision that you'd have to make with your financial planner and such. But I have changed my opinion on that myself. I would tell you that it probably would make sense at today's interest rates to have some kind of mortgage on your property.
Right. Well, and I've seen that too with our clients, especially if you're going into retirement. I think having a mortgage and not having all of your equity tied up in real estate, it just gives you some more flexibility in retirement potentially. but, you know, there's also that peace of mind, you know, if a mortgage is going to keep you up all night, like, you got to weigh the cost of that too. So it really seems like you have to have a trusted advisor kind of walking you through the mortgage process, because every situation is unique. What questions should a consumer be asking when they're trying to find that trusted mortgage advisor?
So most likely you're going to have people who can recommend folks that they had a very good experience with. There's the National Mortgage Licensing System. It's called the NMLS. You'll see this number listed with anyone's on anyone's advertisements in the mortgage industry. There's a consumer website that you can actually go and look at that NMLS number and kind of see where that person's been, what kind of roles they've had. You'll find everything from mortgage bankers that, you know, 3 years ago were bartending. Mm-hmm. That doesn't make them bad, but, you know, that maybe is not the length of time that you wanted to see somebody advising you on a mortgage,
right?
Versus you can see a history of their employment over a number of years. But really, it's a trust thing. And, you know, in my own personal business, my business has been built from trust of referrals. So if I do a good job and, you know, folks feel comfortable with me, then that's ultimately most likely where you want to be. A lot of people come in and the first thing they ask you about is an interest rate. And I can tell you, if you find the lowest interest rate, you're probably not going to find the best service. Mm-hmm. You're probably not going to find a person on a weekend to ask a question or in the evening. However, the dedicated mortgage bankers, you can pretty much get anytime you need to have a question and they'll respond very quickly to you.
Oh, that's very good to know. You know, I know I've asked that question, well, what's the rate? Like, who's going to give me the best rate? But I hear things talked about like points, and that you can buy it down, or has that gone away? Like, what are points, and is everybody charging points, or how do you compare mortgage companies? Like, you've got one lender saying, hey, I'm going to give you a loan for 4%. You've got another lender saying, I'll give it to you for 3.5%, but is it really the same?
Yeah, very, very good question. So it's assumed that when you ask for a rate, you have to ask for two things. One's the rate and one's the price for that rate. Mm-hmm. So it's just like going in and buying a jacket off of a rack at Nordstrom's, for instance. You have two jackets side by side, one's $50, one's $100. Obviously, there's a difference in those prices for those two products. In the mortgage industry, you're paying a different price or points, and 1 point equals 1% of the loan amount. So for instance, on a $100,000 loan, if you paid 1 point for that loan, you'd pay $1,000 for whatever rate you were getting from that lender. So it's a little bit complex to shop rates. It's a little bit of an interesting story. One of the executives for Fannie Mae a few years ago called me and was asking about rates, and he wanted to shop around. He shopped around, he called me back and he said, you know, this is very difficult to do. I said, I realize that. Yeah, because you're dealing with a lot of different personalities, and ultimately a loan officer gets paid a commission, so they are ultimately a salesperson, and that's from an extent you just have to realize that that you know, ultimately everyone wants your business. Let me put it that way. Mm-hmm. So,
very, very good to know. So, how do you qualify for a mortgage today? I know you've mentioned a few things like debt to income and how you calculate that, but what are the big things that people need to pay attention to?
So how do you qualify for a mortgage? Wow, that's a long question there.
Maybe I should ask, what are they looking at when you're going through the mortgage process? You know, what would be some things that clients should do to prepare themselves for the mortgage process?
So a lot of times people call you and they want to shop a mortgage rate. And that's a very difficult thing to do. I can give you generalities if you call and you want a rate ultimately because I don't really have enough information to give you a really valid interest rate based on that question. It's more about how much money you're putting down, what's your credit look like, meaning what is your credit score? Is there anything that would exclude you from a particular program? So for instance, maybe a late payment within the last 24 months on a mortgage, that might not fit with a particular loan program. And without having your really a pre-qualification done on you, which includes pulling a credit report, it's very difficult to answer. So you pretty much get a general idea of what we're talking about. But once the loan officer pulls your credit and looks at your, on an application, it's going to be just a guess up until that point.
And then things like income, credit score, all of those things are playing into it. Like I've had a few clients where unfortunately they've gone through a divorce, and now one of the spouses is going back to work, but hasn't worked in a long time. How long of a work history does someone have to have before you can count that?
So in those instances, you really want to see a 2-year history of employment. However, if there was previous employment that you had, then maybe we could tie those together and we could, make that happen sooner. In a divorce situation too, there's typically spousal and child support and things of that nature. There are rules around how long that income needs to be flowing to you before we can use that as well.
Oh, so, really? Even though there's court documents ordering it, it has to be shown a track record of it.
A certain length of time, yeah.
Interesting. Let's see. I have so many questions for you. I feel like I could go down a rabbit hole of questions. So what are some considerations? Say you've got a mortgage, you're not going to be leaving your home anytime soon. It's your forever home, or maybe it's just your home for the next 5 to 10 years. What are some considerations for whether or not you should refinance right now?
That's a very good question. So when I look at a refinance, there's a lot of different factors, and you'll hear a lot of people say, well, it has to drop 2% before I'm interested in refinancing. However, if you look at a larger mortgage, a lot of times the fees on a larger mortgage, a lot of fees are fixed on a mortgage. And those fees, if you went from a $200,000 mortgage up to a $500,000 mortgage, the fees are not going to be very much different in either of those cases. However, you're going to save a lot more in a $500,000 mortgage than a $200,000 mortgage. So those are some of the considerations that you'd look at. What is it? How long is it going to take me to pay back the cost of doing that up front? And there's in certain cases, and just this week I had a retired couple who wanted to refinance. We looked at it, and we're pretty much picking up when we talked about discount points just a minute ago. If you take a little bit of a higher rate, we can give you a credit back towards your closing costs. So in their particular instance, they're paying a few $100s to refinance a $500,000 mortgage, and it's really not costing them anything to do it.
Oh, that's great. And then sometimes when you're refinancing, do you suggest like a shorter term, or maybe say they're only going to be in the home for another 5 to 7 years? Do you suggest a different type of product, maybe interest only? Do they do interest only anymore? How does all that work?
So very good question. So how long would what is the time frame you're going to be in the house? How many years do you have left on your mortgage? Do we want to go backwards? Meaning, do you want to go from you paid it down 5 years and now you're on a 25-year mortgage, and do you go back up to 30? Even though your payment looks much better, you might not be saving any money if you really calculate the overall cost. We could maybe take you from a 25-year mortgage down to a 20 or 15-year mortgage. The 15-year rates would be considerably better to do that. However, your payment would obviously be higher in that particular instance. And how long are you going to be in the house? So you brought up 7 years. Well, there's a 7-year ARM, for instance. There's a 10-year ARM. And an ARM is an adjustable rate mortgage. It's an acronym for adjustable rate mortgage, ARM. And those products ultimately, typically the rates are a little bit lower. And why would you take one of those types of loans? Because they're fixed for the period of time which you need the loan. So maybe you're going to be in the house for 6 more years and you're pretty certain you're going to sell it. A 7-year ARM, if it's a lower rate than the 30-year fixed, might be an option you'd consider.
Right. And so are you paying principal and interest during that period?
Yes, it's amortized just like a fixed rate 30-year mortgage over a 30-year period. It just, at the end of 7 years, it isn't fixed anymore. It will start to adjust for some period of time after that locked period, for instance.
Interesting. For clients that are considering a second home or a rental property, is there anything that you would tell them differently than someone purchasing a primary home? Are there different considerations?
So a second home is, primary residence and second home are pretty much, they're not exact, but they're pretty much similar products. So the idea behind a second home is it's a second primary residence, okay? So you might have your house in the city and then you might have a house at the beach that you go to on the weekends. It's really 2 primary residences. We just call one of them a second home.
Oh, okay.
Okay, now when you get to investment properties, that's a whole different scenario. We typically look for more money down. The rates are typically a little bit higher than just a primary or second home loan. And the qualifications are typically a little bit tighter than, because it takes some expertise to be the landlord, right? So those would be some differences in those scenarios. Now, you might find yourself in a situation where you have a primary residence and you're moving to another place that we might have to call an investment property just because of the timing of your moves and such. So there are situations where we would have to re-identify the property, even though it might not be what it is in the end, to make the loan work, for instance.
Interesting. What are some creative things you've seen clients do over the past couple of years? Anything where you're like, dang, that was smart.
Yeah. Well, as a matter of fact, my financial advisor a few years ago recommended it's a line of credit. Some people will put either a line of credit against their assets. It's a secured loan where it's kind of like a home equity loan, but it's against your stocks, where you can write a check against that at any time. You don't need to liquidate the stocks. You don't need to interrupt whatever your long-term financial goals were with that particular money. Some people also, they call them there's a margin loan. I know there's a difference between those. The margin loan is against the stock. That's a better question for you with your clients. But ultimately, those types, as a matter of fact, I'm working with a 55 and older community here locally, and I'm getting a lot of questions on this because there's a lot of assets, and we're looking at having them open lines of credits for their down payment because they don't want to liquidate the stock. So those financial advisors are opening up lines of credit on those. That has been a very popular way to use for the down payment. Right.
Particularly if they're planning on selling a house and they're able to pay off that loan down the road, the new bridge loan is a stock secured loan, I feel like. You know, the old bridge loan, you've got one house for sale, so you put a bridge on it to get you into the next house, and then as soon as that house sells, you pay off the bridge loan.
Yeah.
But you avoid having to come out of pocket cash or sell your stocks and pay the capital gains and things like that.
Exactly. And, I've even seen family members do this. So somebody with assets, you can lien another property, and it's not as difficult as it sounds. So you become the bank, in essence, for maybe somebody who needs that equity out of the house to bridge it to another property. But there's just a lot of ways to structure those types of deals. what we're seeing a lot more of is parents with a lot of assets that want to help their children buy homes and get into the home for the first time.
Right. And what are they, actually that kind of goes into one of my bigger questions is, what do first-time home buyers need to do? What are some tips that you have for them? And then, you know, a follow-up to that is, what are the parents doing?
So I teach a class for the Housing Development Authority, and ultimately it's a first-time home buyer class. It's sanctioned by HUD, and it's a very, very thorough class. I would recommend anyone look into a class like that where they are to really understand the steps of buying a home, and they're laid out very, very well. It goes from the very beginning of what do I do, you know, and we start with the finances.
Mm-hmm.
Really looking at your finances from the standpoint of what kind of money do I have currently, you know, what is my rent, how am I managing my money, to looking at it with a house, what does your budget look like? So we go through this entire process with first-time buyers. Ultimately, what that does then is leads us into the next questions about saving money. How do you save money for a home? And there's different programs. The state, actually in Virginia, has a program that allows you to put up to $50,000 into an account for a first-time buyer, and you can defer any taxes on that as it grows.
Oh, well, and you know, if any of our clients listening, I'm sure you have like a flyer or something about that.
Yeah.
I don't want to go too far into the weeds today, but if any of our clients listening would like a copy of that, I can certainly provide that to them.
Absolutely.
Yeah.
Absolutely. So, and then on top of it, you know, where do you go with the credit with this particular purchaser, right? So ultimately it's, can I afford it? How am I going to afford it? Where am I going to get the money for the down payment? And there are an immense amount of programs for first-time buyers now. There's discounted rates through counties, especially in higher priced counties, in different metropolitan areas. There's a first responders type programs that is a culmination of grant money that comes from the states as well as the federal government.
Oh, for like paramedics or firefighters?
Teachers, yeah. So right now, as a matter of fact, there's a police officer that we're working on a loan for, as well as a teacher, just in two different jurisdictions, but they're both getting a significant amount of their down payment paid for free. And then that is, there's no strings attached. You just have to fall within certain income limitations and make sure you haven't owned a home in the last 3 years. So those are the things that are vetted in those particular instances. But the biggest thing is credit, right? So when it gets down to it, it's, can I afford it? But, you know, you look at the credit and, you know, there's a lot of talk about, the student debt and all this other stuff that affects it. But, you know, the guidelines have really kind of opened up and allowed a lot of folks to buy first time.
I know actually we've had conversations with some of my clients' children, and you've had them go through the mortgage application process just to see what their credit was and kind of coach them on how to handle student loans, how to handle different things, so that, you know, 18 months from then, they could be prepared to actually purchase that home. I think that's so valuable. Any parents listening that know that their kids want to purchase a home in the next, 1 to 2 years, they really should be having these conversations now. Doctors' bills, things like that, that they may have missed while they were in college or got sent to the wrong address, it could be showing up in their credit report.
Yeah, the cable TV bills, the cellular phone bills.
Yes. It's
all those little things that we find, up front. But you're absolutely right. So what we do is have them fill out it's a full application. We pull a credit, and then we look at it from that standpoint to say, let's look at where you are now. What are you paying? What would it look like? Your payments, would you qualify for these types of programs? And let's defer that down the road. But the more research and the more education first-time buyers have, the better off they will be through the process.
Right. Well, and also the more heads up they give you and you kind of understand their situation, you can look for those programs out there or be thinking about them, or there just becomes more of a strategy versus a reaction, because this is a product you're going to have for a while.
Yeah, and I do want to say one more thing about, first-time buyers. So there's this illusion out there that you need 20% to put down on a home before you can buy a home. There are programs where they can put 0 down now. As a matter of fact, there's ways you can finance and closing costs. I wouldn't recommend these programs for everyone. However, there's programs that for as little as 3% down, it's a pretty typical type of buyer that we're seeing now.
Interesting. Now, what would you recommend, and this actually came up from some of my colleagues at VWG, they've got teenage kids. What do you recommend they do right now to start establishing their credit, or kids in college, what can they be doing? Because you can't get a credit card now until you're 21, right? The Credit Card Act. I don't even know if I'm saying it right, but
yes,
it's harder to get a credit card.
It is. So what I recommend is you can make an authorized user. You can put your child on your credit card. Now, you don't need to give them the credit card,
right? But
you can make them authorized user on the credit card, and that opens your credit file up onto their credit report. So when they do have the ability to apply for a credit card, it's very simple for them, because the bank will pull up a credit report on them, and they'll already see there's a credit history there. Even though it's not necessarily their credit history, it does allow you to start down that path. So
I guess it opens like a trade line on their credit report, so it's reporting, it shows it's authorized user, but it's at least opening up that credit report and establishing that for them.
Exactly.
Anything else that you recommend, like if they're buying a car, that parents are paying for the car, should they have a small car loan as co-borrower?
Yeah, the co-borrower, co-signing, I'm not a big fan of myself. I think a lot of parents have done that, and it's maybe not in the best interest of their child to do something of that nature, just because it puts them on the hook,
right,
in that particular scenario. But
puts the parents on the hook.
Yeah, but if your child can go and open a car loan, or maybe you help them with a larger down payment that allows them to finance that on their own, that's great. I'm not completely discouraging co-signing, but ultimately you just want to watch that careful, and you do want your child to be successful in taking credit out.
And I've also heard, like back in my banking days, you could get a secured credit card. So you're actually securing it by cash, but after 6 months or so, then they could open up their own credit card.
Yeah, exactly. So you put up $1,000, they open a credit card for $1,000, and it's really your own money that you're using in order to finance that. But there's just a significant number of ways. I did a loan recently where the young lady paid cash for everything. So even somebody without a credit history, we would have to build a credit history for them through maybe some other scenarios, such as rent, if they were paying rent somewhere, or if they had cell phone bills that they were paying, and things of that nature. But there are ways for us to help folks that maybe don't even have a credit file.
Yeah, good to know. I think the biggest thing is talk to someone about it. Start planning. Don't just see a house, go out with a realtor, and not think about the financing, before you go out with a realtor. So a few other questions. How can parents, grandparents help first-time home buyers?
What we see mostly with the help is in regards to the down payment. So we would have a grandparent or a parent gift the money to their child. There's a lot of questions around the gifting. We're not the IRS when we're talking about gifts. We're not talking about anything to do with the IRS, and there's limitations that the IRS puts on citizens to how much they can gift and so forth. That's a question that I stay away from.
Great. That's a question for your financial advisor and a
yes.
state attorney to work on, and
yes.
your CPA.
But so there's certain rules around the gifts and what we have to see and how that money's transferred from a relative into an account. So I'm just going to say typically it has to be a relative that gives you the gift. However, every program's a little bit different, and that would be something to ask your loan officer.
Okay. Any additional thoughts, things that people should consider? Any lasting tips that you have?
Well, I just, I think home ownership is one of the things that makes people very, very happy. 2 years ago, I helped this young family get into the home. They had some financial difficulties through the credit crisis. And this young man, after, going through, we restructured a lot of things for him. He gets into his house and he calls me and he said, "You don't know how happy this makes me to be in my home." And, you have all those memories built in your home,
Mm-hmm.
The home that you struggle to get into to begin with is the home you might have been your first home into the home you live in as you retire. So, those are, I'm just, so proud of being in the industry where we can help finance people's dreams like that.
Yes. I always think that as a financial advisor, the work you do is transformative. And I think helping people through one of the biggest decisions in their lives, like purchasing a home, is certainly transformative work. I mean, you're transforming people's lives and helping them. And of course, BWG, we do stress financial planning because we really think that having a financial plan drives all of these other decisions and helps also, form the basis for coming to people like Patrick for mortgage questions, because you just have a better understanding of your entire situation once you know where everything is, where you're going, what your big goals are, what your cash flow, understanding all of that. So again, we really stress the financial planning process and working with trusted advisors to help you create your financial structures and financing options. So thank you so much, Patrick,
Thank you.
For joining us. And if anyone has any questions or they would like any additional information, you can reach out to Delaney. Her information's on the screen, or call your financial advisor at BWG. Thank you again.